Well, good afternoon. My name is Ala McCoy. I'm Director of Startup Support at University of Maryland's Ventures. And I would like to extend a warm welcome to all of you who joined us today for the next installment in Startup Fundamentals Workshop Series. Both live webinar audience and those watching a recorded version on our Startup EMD YouTube channel. This workshop series is offered by Ventures at the University of Maryland. Everyone attending the live session, please feel free to submit questions using the Q&A function at the bottom of your screen, or you can also use the chat, whichever one is easier for you. We are recording the session, and it will be posted on our YouTube channel, and therefore I enable for you to be able to submit your questions anonymously if you wish to do so. But you don't have to. So today we will cover a very interesting topic on how investors value startup companies. And I'm very pleased to introduce today's speaker, Nigel Long. Nigel is the founder and senior managing director of Straight Street Advisors LLC, an advisory-focused investment banking firm with associates in Charlotte, Washington, D.C., Chicago, and New York. Straight Street performs valuations of over $50 billion monthly of illiquid securities and derivatives, including valuations of hundreds of companies per year. So as you can see, Nigel is an entrepreneur himself, and he's very experienced in evaluating startup companies as well as larger companies. So Nigel, thank you so much for joining us today. I'm gonna turn off my camera, turn off my mic. However, I'll be here monitoring the Q&A. Please do submit those questions, and Nigel, the floor is yours. Thank you.
Thank you so much, Ala, and thank you everyone for joining to discuss this somewhat interesting topic, how to value a startup company. So just a little about myself. Ala gave a brief introduction. I'll cover a couple of other things. As she mentioned, I'm the founder and senior managing director of Trade Street Advisors. I have over 25 years of experience advising on a number of transactions, financial transactions involving debt and equity, invested in or advised on over $1 billion worth of private equity, private debt, and real estate transactions. Been fortunate to be a senior advisor and continue to be a senior advisor to several Fortune 500 companies, as well as to a number of smaller to mid-sized companies. Very passionate about contributing in areas where the capital markets and public policy intersect. And so I'm very pleased to be involved with the university in some of its investment endeavors. So our firm, as Ala mentioned, we were founded in 2009. We're actually based in Charlotte, North Carolina. We have associates here in Charlotte, in Washington, D.C., Chicago, and New York. We're an advisor to financial institutions, institutional investors, as well as issuers of debt and equity. For our strategic financial advisory practice, we support institutional investment managers with investment policy, strategy, processes, as well as asset allocation. We were engaged and continue to be engaged by the University of Maryland to support the university in centrally managing its portfolio of investments in private spinoff and technology spinout companies. And as Ala mentioned, our valuation advisory practice performs monthly valuations, and actually we're over $60 billion a month of debt and equity securities and derivatives, including valuations of hundreds of companies per year. And we support, as I mentioned, investment managers and asset managers. And so the context in which we perform our valuations are typically in the context and from the point of view of an investor. So the goal for today, I want to leave with you a very simple, easy to apply method for valuing your company. Not going to cover how to perform an actual appraisal of the company, but I want to leave you with, again, an easy to apply relatively simple method for as a starting point for thinking about a reasonable valuation range for your company. Now, who is this presentation targeted to? One, it's going to be high growth, emerging companies in areas that align with the university's what we call discovery portfolios. So these are areas like climate, adaptation and sustainability, computing, data and discovery, human health, national and global security. In terms of stage of development, these are companies that, are pre-Series A. You have not yet raised a Series A venture capital round. So you're probably somewhere in the angel or seed stage of development. This is for companies that are either in between or about to launch, which is referred to as a price round, or you're just thinking about launching a price round. And a price round is the sale of preferred shares having a stated equity valuation. And you're thinking about what is a suitable valuation range. Now, typically, you will negotiate the valuation with the lead investor, but it's a good idea to come into the conversation with some reasonable idea of what your company is worth today and how much of your company you are willing to exchange for a new investment. The focus here is on equity valuation and not on a direct valuation of the IP being commercialized. Now, having said that, the IP being commercialized for companies that are angel and seed stage is obviously central to the valuation of that company. And so it's a very important topic, and it does obviously come into play, and we'll talk a little bit about that towards the end of the presentation. But today, we won't focus on the actual methods for performing an IP, standalone IP valuation. We'll just talk about it in the context of the valuation of your company. Let's cover a couple of key concepts in a few terms. Again, what we're going to drive towards is a simple method for valuing your firm, but it's a good idea to just cover, again, a few key concepts and a few terms before we jump into that example and talk about that method. So obviously the first question would be what is value? Let's have a common definition for what we mean when we say value. So a valuation can be an asset's fair market value, or it can be its investor-specific investment value. And when we say fair market value is the price at which the property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of relevant facts. So typically, fair market value is not going to be applicable in scenarios where there are distressed sales. It will not be applicable in scenarios where there's a sale between affiliated or related parties. The concept here is that this is a transaction between arm's length parties. Then there's investment value, which on the other hand is the value of an asset to a particular owner or prospective owner for individual investment or operational objectives. And in some jurisdictions, investment value is referred to as value to the owner. Now, fair market value and investment value will not be the same, but they should have some reasonably close relationship with one another. It would be highly unusual for the fair market value of a company to be, let's just say, 20 million, but the investment value of the company is 80 million. It's just there's typically some relationship between the two, although they're not exactly the same. There are a couple of other terms that I know if you dialed into this webinar or joined this webinar, you've probably heard. And so it would be good to just talk about them and put them in context. So enterprise value is the value of the whole company. It's the sum of the interest-bearing debt, the value of the preferred and common shares, the convertible securities, and the option pool minus cash. Or more technically, it's actually minus excess cash. But for the sake of this discussion, it is all of the invested capital, the interest-bearing debt, the preferred and common shares, convertible securities, option pool minus cash. Then equity value is the enterprise value plus cash minus interest-bearing debt. And so equity value represents the value of the claims that the owners in the company have on the company's assets. And then from equity value, we derive post-money value, pre-money value rather. So pre-money value is equity value just before the new cash from an investment in the company is added to the balance sheet. So if you're about to launch a round, the pre-money value is the value of the company today, just prior to launching the upcoming round. And again, this is something that's typically negotiated with the acquirer or the investor. And so the post-money valuation is simply pre-money value plus the new cash from the investment. And the relationship between pre-money value and post-money value is what determines what percentage ownership of the company you have sold to an investor. So these four terms are very important terms. So now that we've covered a few basic terms, what are typical valuation approaches? So evaluation approaches applied by a valuator, investor, or acquirer are situation specific. It completely depends on the context. In one scenario, using a certain valuation approach in one scenario may not be suitable for others. And we'll talk a little bit more about that momentarily. And they depend, again, on the scenario, the company's stage of development, and numerous other factors. So what are the typical valuation approaches? There are four, and I'll talk about each one just at a very high level. So first is the asset of cost approach, and that measures the value of an asset by the cost to recreate or replace it with another of like utility. And if we would take this out of the investment or business context and put it more into a kind of real world example, maybe one way to think about it is if you were considering buying a home and you're in a market where there are existing homes, but there may be plenty of land and lots available to build a home, then it's highly unlikely that you're going to pay significantly more for an existing home than you would if you could also, when you weigh out all the pros and cons, if you could build a home that has the similar or same characteristics. So the price of those assets are going to be limited to, whether or not you can actually recreate it for the same cost. This is not an approach that's really helpful, in the emerging technology context. It's really used in valuing holding companies, capital-intensive businesses like real estate, or companies that must sell under adverse circumstances. So a liquidation scenario where you're going out of business. We hope that doesn't happen. But, at that point, the value of the company is just what can the assets be liquidated for at that point. Then we have the market or sales approach. And this value is determined based on prices that have been paid for similar items in the relevant marketplace. Again, to take this out of the investment, context and just put it into more of a, everyday, more real life scenario. If you were thinking of buying a new car or another car, you're probably going to compare, look at the prices of recent sales prices of cars of similar make, model, year, mileage, et cetera. And that will have some bearing on what you think you should pay for the specific car that you're looking for. And that essentially is the market or sales approach in a nutshell. And there are various methods for applying that approach. There's the market capitalization method, which really only applies to publicly traded companies. The guideline M&A transaction method, which looks at transactions of similar companies and then tries to apply those multiples to your company. There's a subject company transaction method, which looks at actual, like what is an investor actually paid for, a share of your company. And then there's the guideline of comparable public company method, which is useful in some instances, even for early stage companies, but really it's not directly applicable to the emerging technology market, at least not at the early stage. Then there's an income approach, and the income approach values the income producing capability of the company. And this is a method that is that you will find that most VCs will use, where they will look at your company and they will think about it from the perspective of a successful exit. How much can you sell the company for at a successful exit, whether it be M&A or IPO or whatever the scenario might be. And then they'll look backwards to determine, hey, this would be the value of the company today. And what they're doing is essentially a discounted cash flow analysis. And so we're not going to cover income approach today, but it is certainly an important method that is used, and it captures certain nuances that you just simply cannot capture with the other approaches. Then there are alternative approaches, and these alternative approaches, in a sense, they actually would fall under the market or sales approach. They're just methods that are newer, that have been derived more recently to value companies that historically would not have needed a valuation, such as emerging technology companies. I refer to them as actuarial methods, in that they assign specific dollar value adjustments based on certain risk factors, the technology development risk, execution risk, market risk, et cetera. And these alternative methods are more appropriate for valuing pre-revenue companies or companies that have not reached just kind of stabilized revenue levels. And there are multiple methods. There's a scorecard valuation method, risk factor summation method, and other methods with very interesting names like the Burkus method. So the one method that I would zoom in on here would be the scorecard valuation method. And so we'll talk a little bit more about this alternative approach and what it means, because of all of the valuation methods, it's probably the most accessible. It's the easiest to understand. And frankly, in my opinion, going through the scorecard valuation process internally as a company also focuses you on some very important things to think about. So first, the scorecard valuation method values your company relative to other early stage companies that are pre-revenue or have reported very limited revenues to date. And the starting point is the median pre-money value of recently funded startups that are comparable to your company. And we call these valuation comparables or valuation comps, a very important concept, which we'll talk about in a moment. Then a scorecard is used to compare your company with the valuation comps on the basis of several factors that have a direct impact on the valuation of your company. And the resulting valuation is subjective. It would not be considered a fair market value. It would be considered an investment value. But even though it would be considered an investment value, it should result in a valuation that's within a reasonable range of a fair market value. So in other words, if the median pre-money value of recently funded startups in comparable startups in your industry and stage of development, if that's 15 million, it would be very, very difficult using this method for you to derive a valuation of 75 million. I mean, it would just, it would be very difficult to do. So it does it's an approach that kind of tethers your internal valuation expectations to market realities. And before jumping into an example of the scorecard method, let me just take a moment to talk about valuation comps. So the valuation comparables, valuation comps are probably one of the most important aspects of evaluation. If you were to go back to the example I gave, the real world example I gave earlier about the market approach, if you were to, if you're looking for a Camry, it's probably not very helpful for you to look at, Porsches as comparable, cars. So the selection of the valuation comps has a tremendous impact. And I think it's very important to be very realistic about, what companies and types of companies are actually comparable to your company as you begin the exercise. By definition, IP is unique and novel, but irrespective of how unique your IP or innovation is, investors will group the company with other investment alternatives so that they can make relative comparisons. Any of the methods that we use to value the portfolios that we manage or that we advise on, there's always a reference to what is happening in the market, like what other people are actually, how other companies or similar investments are actually being priced and valued. So it's important to realize that uniqueness is important, but from an investor standpoint, we have to look at how do you compare to other alternatives, where we could actually put our money to work. And so a valuation comp is a company that has recently closed a price round and is similar to your company in terms of industry classification, product, service, target customer, stage of development, or business model. My recommendation, and I would recommend that if you don't do valuations full time, you're focused on your company. My recommendation is to use the median pre-money valuation of your company's industry stage and development as your starting point. So you want to do this for two reasons. One, it's actually relatively easy nowadays to find than specific valuation comps. So the median pre-money valuation, or even the average pre-money valuation for companies within our industry's stage of development, industry and stage of development, are relatively easier to find. It also eliminates the need to have to make certain deal specific adjustments that you have to make if you were to select, say, 5 comparable transactions. Typically, you don't have enough information to know what drove some of those valuations. It could be one deal might have had investor-friendly terms. Another deal might have had terms that were not as investor-friendly. And so by taking a median, you can just use some sort of central number that you can then make adjustments to, which is what we'll do in this next example. Now, where can you find median pre-money valuations for your industry and company stage of development? PitchBook is a great source, but that's a subscription-based platform. You can actually find some of this data for free if you go to Carta Data Desk, and I put the link here and can share that in the chat a little bit later. But that's free, and you can kind of go on there, play around with it, and you can actually see, hey, for companies that are, say, in the seed stage of development in a specific industry over this period of time, these were the median pre-money valuations for those companies. And it's helpful to use that as a starting point. Then let's get into an example. This is an actual example. So as you can see, we started with we actually started with the pre-money valuation for the industry in which this company operates, and it ends up being about $10 million. Then we actually undertake a scorecard exercise, for lack of a better word, that then rates the subject company, our company, relative to how we think our industry peers perform. And there are 7 factors, management team being the most important, how experienced are the founders, are the founders serial entrepreneurs. That's given a weighting of 30%. timing of the opportunity. Is the market ready yet? Is it too early or is it too late? That's given a rating of 20%. Size of the opportunity. What's the target addressable market? Is it scalable? Are we first movers? That's given a weighting of 20%. The product and technology, is it easy to copy? Are there barriers to entry? Is there protected IP? That is given a weighting of 15%. The competitive environment, marketing, sales channels, partnerships, and others are given lower weightings of 5% each. Because again, remember, we're talking about earlier stage companies. And then for each of those categories, you will rate your company versus peers. And obviously this is very subjective. And, more than likely, there are some areas where you may rate yourself higher than maybe an investor would rate you. But that's okay, because it's still a great exercise and opportunity to sit down with other members of your team and to really think about the company in the context of its competitive environment and what does that mean for its valuation. So in this case, for the management team, we gave them a rating of 1.5, which means we think they're somewhat superior to the typical management team that we would see for other companies within that industry. And so that translates into a weighted score. We thought they were pretty much in line in terms of the timing of the opportunity, size of the opportunity, and some of the other factors. So we gave them a rating of 1. We thought they just pretty much aligned with their peers. However, their product and technology, we thought they were extremely superior relative to other companies and for various reasons. And so that impacted the weighted score. And what happens is at the bottom, there's a company score, kind of an index basically. And in this case, the company score was 1.3. So then what we came to an estimated pre-money valuation, take the industry pre-money valuation, in this case it's 10 million, and multiply it by the company score of 1.3. And so we felt that, hey, a $13 million pre-money valuation is a reasonable way to think about the value of this company today on a pre-money valuation basis. What are pre-money valuation ranges today in terms of median deal sizes and pre-money valuations? And we looked at this as the trailing 12 months as of the end of Q1 2023. The source was PitchBook. First, just kind of looking at the stages: angel, seed, early stage VC, later stage VC. You could look at typical size of a financing round. This is in millions. So 250,000 for angel, 3.5 million for seed. And then you could see how the rounds ramp up in size, as we move further into the company development stage. And then we break it down by industries: B2B, B2C, energy, financial services, healthcare, information technology, materials and resources, and then overall. And you can see, as you would expect, valuations in each of the categories would tend to rise, as the company develops further. And for angel, typically we're looking at a $5 million pre-money valuation, which might sound lofty, but that's what the actual deal showed, and that's what we're seeing today. In reality, seed, irrespective of the industry, tends to center tightly around the $10.5 million pre-money valuation median. Early stage VC, as you can see, the valuations continue to go up from there. We also thought it interesting to look at year-over-year growth. I think any of you who are invested in the public markets, you will know that, the public markets have sold off since, a year ago. We would have looked at, if we did the same analysis in March of 2022, we would see that for the VC, the later stage, and for early stage, you would see that the valuations are lower. In this case, close to 10% and 26%. But interestingly enough, for the earlier stage, angel and seed, we see that values have either just hung in there or they've actually increased. Now, there are a couple of reasons for that. One is that there is a greater level of investor interest in the early stage. So you are seeing actually more of a greater variety of investors who are interested in looking at angel and seed stage companies that historically would not have. But then also too, there are fewer priced deals, meaning there are fewer deals that actually have a stated valuation. Typically, what we're seeing is for companies that need to raise money, we're seeing a lot of convertible securities, things like safes, and we're seeing a lot of safes now actually, and convertible bridge notes, and those don't have a stated value. And in fact, one of the reasons you would issue a safe or convertible debt instrument is so that you can largely avoid the whole valuation discussion. And so we're seeing more of those. And so what's happening is there are fewer higher quality price deals. And then you're seeing a lot of deals that would probably indicate a down round, actually using convertible securities to fund their milestone development. Does IP increase equity value? As I mentioned earlier, the focus here is more on equity valuation versus the standalone valuation of the IP being commercialized. But obviously the intellectual property, the IP being commercialized is maybe the central component of value for most companies who at the early stage. And according to PitchBook, IP can prove to be tremendously valuable, especially if it is well defended with patents. And according to that same research, which was published in February of this year, a strong correlation exists between the presence of patents and the ability to raise rounds at higher valuations and achieve larger exit values on average. So the analysis that PitchBook did were for the years 2011 through 2020. And what they observed is that deal sizes for what they refer to as patent startups are 40 to 60% larger than those for non-patent startups in a given year. They also observed that across stages, what they refer to as patent companies raise capital at notably higher valuations than non-patent companies. So looking at angel deals, the angel deals show the largest difference. So the annual median is the angel companies with patents or patent activity, their valuations were on average were median of 93% larger than non-patent companies at that same stage. And if you think about it, that kind of makes sense. I mean, first, the remaining economic life of the patent is just longer, obviously, because it's earlier stage. The patent also often provides a protective moat. And then also many angels just have more of an affinity to, and just a comfort level with the technology and innovation. And then having some sort of patent or patent protection just reduces or de-risks the investment from their perspective, which lower the risk makes it worth more. And then we can see that the premium persists throughout the remaining stages. So 17% at the seed stage. And then as we enter the early VC stage, 30%, and then 51% at the late stage, because at that point, now we're actually commercializing the IP and we're developing market traction and a track record. And it's clear to define the value of that IP at that point. So actually, I'm going to stop here. Alo, are there any questions that I could answer?
I don't see any questions right now, but actually I have a raised hand, so we can allow a first person to question. So you can either raise your hand and I will allow you to speak, or you can also type up your question. So, okay, Herbat, you are welcome to ask your question.
Hey, can you hear me?
Yes.
Yes.
All right. Could you talk a little bit more about convertible securities and bonds? And for example, if you've seen the company issuing setting up a deal for share buybacks or options after a funding round, if you've seen anything like that, or if you could just talk more about that.
Okay, so first, in terms of convertible securities, yeah, we see a lot of matter of fact, we're seeing more at the earlier stage convertible securities being issued than we saw in the previous, say, the 2020 to 2021 vintage of price rounds, financing rounds. So obviously, we're seeing a lot of safes. Typically, the earlier the deal, that's the more safe that we're seeing. And safes are just, as you may already know, but just for those who may not, safes are simple agreements for equity, and they're just called safes. Y Combinator originated them, and they're pretty straightforward and simple tool to use. And you can raise the capital now, and then there's certain terms that you can figure out once an actual qualified financing takes place. It's similar to convertible debt. Convertible debt just simply has an interest rate. It has a maturity date, which safes do not. And so it just has some different features. And typically, the more mature the company, they're typically moving more towards convertible debt and have not yet fully adopted safes, which may not be appropriate at that stage for them. Now, in terms of the share buybacks, maybe you can give me a little bit more about the context of what you would be trying to accomplish with that.
Sure. So for example, let's say that there's an angel investor or a VC, and you sell 20% of your company to them for $1 million. And then you put in a clause that in 5 years, I as the company owner have the option to buy back that 20% at $5 million, for example. Have you seen anything like that? You just give some the VC some interest, and then you have the option to buy back the shares that you sold.
Yeah, that's a call option, and yeah, that's it's interesting. That is something that you do often see with more mature companies in some of their debt offerings. Is they want to have the opportunity to call back the shares at a specific price. Now, so number one, that is something that happens. I don't see it that often at the earlier stages, angel or seed, but it is, I guess it would say it is a thing. It is something that you could do, and it depends on the investors as to whether or not they would, that's appealing to them or not. From their perspective, if you were to sell to me what I call some sort of callable instrument, whether it's equity or debt, then there's a deal that I want from you. Like for me, that makes my shares or the debt that I'm investing less valuable, because what I'm doing is I'm potentially giving away upside. In the example that you used, let's say the company is worth a lot more than $5 million. When you are ready to exercise your option. So to me, it caps the upside value. And for that, I would think in terms of, I may take that deal, but I want to reprice what I'm giving you, because I need to be compensated for the loss of that upside. Does that make sense?
Yes.
And in fact, that is actually what happens. If you look at debt being issued and callable debt being issued, what you would typically find is that callable debt will carry a higher interest rate, just because there's you're essentially selling the issuer an option to buy the debt back from you.
Thank you.
Thank you. So I don't see any typed up questions, but I will go ahead and ask one myself. So in your presentation, when you were talking about what factors go into considering the value of the company, team was your number one and probably the heaviest valued. So I wanted to ask, how do you go about valuing a team? What would a good management team that would earn 1.5 or 2.0 look like? And what would a bad management team look like?
Okay, so let me talk about a good management team, at least as it relates to this specific valuation. So in this case, the management team were serial entrepreneurs. They founded several successful ventures. And so you had a great degree of confidence in their ability to execute on their business plan. And for that reason alone, we would just weight them higher than their peers, just because they bring to the table experience and a track record that suggests that they may have a better shot at actually making this work than a team that doesn't have that same track record. I would think that I don't want to say what a bad management team would do, but what I found, if I can speak specifically about what I've seen at University of Maryland portfolio, we found that often it is more difficult for a CEO who is not full-time, is not fully focused on that company, to build and develop the company in the way that a either professional CEO could do, or a founder who has some business skill sets and capabilities, but who's decided, hey, I'm going to leave the university, I'm going to walk away from research, and I'm going to focus 100% on this startup and making it work. So I would say if you have a management team that has kind of split, split allegiances and priorities, they would probably, score somewhere less than 1 using this scorecard. So that's just an example, but a lot of this is obviously art versus science, and some of it is you kind of know it when you see it, and but broadly, track record and commitment are big factors.
Thank you. That's a great point. So we have 2 submitted questions. I'm going to go to them first. So the first one: would it be more difficult to patent an algorithm? How do startups leverage their IP and create something that others can't replicate in order to achieve a competitive advantage?
Yeah, so that's I think that's that's a different question from the valuation question, and all I know is one that you have a lot of expertise in as well. Well, certainly a lot of expertise, and probably more than me actually. But so obviously with IP, some IP can be actually protected in terms of a regulatory or legal type of protection, patent, copyright, trademark, that type of thing. And then there's some IP that, frankly, you can only protect through NDAs, non-disclosure agreements, confidentiality agreements, non-competes. And that's really about the only way that you can protect it. In that scenario, I think, again, just being an early mover, showing early market traction, showing that there actually is a market for that innovation, it is really the only way to from a valuation standpoint, I think, to get people really excited. They have to be able to see that the market actually ideally needs this, but that the market would adopt this and would want it, and it can scale. And you can scale fast enough that by the time the competition figures out what you're doing, you're already ahead of the game, either from a competitive standpoint, or maybe you would make a great acquisition target for a larger strategic.
Yeah, thank you. Yeah, and it is difficult. So software companies are somewhat different in that regard too. So some industries, IP value is much higher, like life sciences, for example. You cannot commercialize a life science technology without having strong IP protection. But others, it's not as crucial, as long as you are able to maintain trade secrets and other forms of protection. So thank you. Next question is, are you able to go over the nuances of enterprise value and post-money valuation? They seem somewhat interchangeable.
Okay, so the question is post-money value versus enterprise value?
That's how I understand it, but the attendee who asked if you could correct us if we misunderstood your question.
Okay, so well, let me let me just take a step back, and then if I don't answer the question, please ask it again, because it sounds like an important distinction that needs to be made. If I'm understanding the question is the difference between enterprise value and post-money value. So again, just if we just take a step back, so enterprise value is just really looking at the value. Another way to say it is the market value of invested capital. So it's invested capital will include interest-bearing debt, that is senior loans, which are not really that common for earlier stage, but we certainly see them. So in your creditors, this is going to be interest-bearing in the interest-bearing debt category. And then you have the value of the equity, the preferred and common shares, as well as the option pool and the convertible securities. But the key here is minus cash. And why is it minus cash? Because, over a certain amount, cash is not really considered something that has added value until it is deployed in a way that adds value to the company. It is something that the equity owners still have some ownership in. It is obviously something that de-risks the company some to have cash runway. It is obviously something that companies vitally need, especially if you're not yet cash flowing or profitable. But it's actually not considered in the traditional understanding of enterprise value. Because what we're really trying to understand is what is the value of the capital that has been deployed in building the business. Now, when we go to equity value, this is where we add cash back, because even if cash is not considered in the enterprise value definition, it is still something that is owned by the owners of the company. And so equity value considers cash, but just subtracts the interest-bearing debt. And it just says, hey, this is the value of the owner's interest in the company. Post-money value is just simply, hey, this was equity value just before someone made a new investment. This is equity value just after the cash from the new investment was received. One thing to keep in mind is none of this changes enterprise value immediately. The new cash received doesn't begin to impact enterprise value until it's deployed in a way that adds more value to the company. It's deployed in a way that helps the company successfully reach certain milestones. Other than that, it is really just kind of a pool of cash that the equity owners do have a claim on, but it's not considered enterprise value. So launching a financing round literally does not change the enterprise value mathematically. It does not begin to change the enterprise value until the cash from that round has been deployed in a way that successfully increases value. And hopefully what will happen is over time, the enterprise value will increase and will result in ever higher equity value. And so that the pre-money valuation for the next round will hopefully be higher than the post-money value for the existing round.
Thank you. So the person who asked the question says that answered my question, and thank you, Nigel.
Thank you.
So thank you. Any other questions? Well, here's another question. Is there a downside or to having a very high valuation for any startup, or the higher the better?
Well, it really depends. It depends on what your financing needs will be going forward. And when we say high or low, I think maybe I'm interpreting that to mean is the company overvalued or undervalued. It's it's not good for the company to be overvalued or undervalued. But frankly, in a sense, it doesn't matter unless you actually need to raise more funds, because that's when the whole enterprise value question comes into play. Now, there are other, we can go into tax reasons. We can go into what incentivizes employees and managers from an equity compensation standpoint, and whether or not having a lower value is better than higher value. But if we're thinking about it from the investor's standpoint, a high enterprise value that's overvalued absolutely could hurt the company's ability to raise more capital, because you run the risk that an investor will look at, you're just not going to be able to come to the right terms with an investor. And in fact, that happened a lot and quite often at the beginning of the first and second quarter of 2021. So if you recall, or rather 2022, as you recall, 2020 and 2021, as we moved into later 2021, those were record years for valuations, record years for companies raising, financing. And it was record years for the stock market too, if you were invested in the stock market. And then a series of events occurred, and we saw a sell-off in the markets that also impacted the private markets as well. And there were a number of deals that were moving along well, still at the term sheet phase, obviously, that had to be repriced, and many of those deals just did not get done. Repriced meaning that all of a sudden the valuation made sense one day and it stopped making sense the next day. And so those deals simply just did not get done. And we saw a lot of transactions canceled. And in fact, we've seen a number of deals decline. And a lot of that has to do with just a disconnect between, the value that the seller believes the company has and the value that a buyer believes that the company has. Now, again, if let's put aside the impact on equity compensation, like if you have an option pool, and what does the strike price mean for in terms of incentivizing a team, let's put that to the side. If you have a enterprise value that's high or low and you're in between rounds, it kind of really doesn't matter. It only comes into play when there's a financing round to be discussed. The other implications that come into play at that point, tax, accounting. For our investors, we have to do mark to market, so it matters to them. So I don't know if I answered your question, but
yes, no, absolutely. That was perfect. You even added to my question. So any other questions? I think Herbata saw you at some point holding your hand again. Did you want to ask another question? We have maybe another minute or so before the hour is up.
I think it was already answered. It was related to what if we don't want to strategically get a patent and again protect it through the company through NDAs, and I think it was already answered. Thank you.
Yeah, thank you. Yeah, and that's the patent. We have a number of workshops on our Startup UMD YouTube channel, and I need to go back and add. We recently had a great workshop on patent strategy for startups. So if you follow Startup UMD Business Fundamentals YouTube channel, you will be able to see more from the point of view of IP attorneys who work with startups. So thank you so much. Thank you, Nigel. This has been fantastic, really informative, and very useful. This workshop will also be posted on Startup PMD YouTube channel, so you can watch it again. Thank you so much to everybody who came and asked great questions. And again, thank you so much, and have a great day.
Thank you. Take care. Bye.
Bye-bye.